All right, what's up, everyone? Very excited for today's video. We're going to talk about the signal from the bond market. Okay, when you take a look at smart money and dumb money, there was a divergence there. Oftentimes, these negative divergences can lead to sell-offs in the stock market, and we've seen that. Not only that, there were plenty of other signals. We had a negative divergence in the high-low index relative to the S&P 500, as well as in the McClellan Summation Index. Okay, so we're going to review these, teach you guys about these so you can spot them in the future. We also had the divergence between the dollar and the US stock market. Typically they move opposite of each other, and there's often these 4-month divergent periods that tend to be followed by a quote unquote a rug pull. And if you guys were paying attention to the channel, over the past few months, we talked about this 4-month divergence coming and the possibility of a rug pull. All right. We also had a negative divergence in relation to credit spreads. Now, not everything's going to be negative in today's video. We're going to talk about some buy signals as well. So those are some sell signals. When you take a look at the percentage of stocks above their 50 SMA, it came down to extreme lows below 20%, right around 17, 18%. We'll review it. All right. That is oftentimes a short-term buy signal that can develop into a longer-term buy signal. When you look at growth versus value, this was another signal that we had here that we were posting in the Discord. Just showing that growth is still outperforming value, even as the market was going sideways in this period here, which is typically what you see in a bullish environment, is you'll see growth outperforming value in both the small caps and the large caps. We've also got the NYSE advanced decline line right here. Looks good, right? It's not breaking down. We are seeing a little bit of a consolidation here, but nothing screaming, bearish about this. All right, we'll take a look at Bitcoin, the Nasdaq, and the S&P 500. 2 out of 3 of these are breaking out. Perhaps the S&P 500 can follow. We'll also take a look at the Dow theory by looking at the Dow Jones Industrial Average, the Dow Jones Transportation Average, as well as the S&P 500, and discuss the Dow theory a little bit. And then we'll take a look in under the hood, okay, and see, is the market risk on or risk off at the moment? There's 2 areas where the market could improve, and that's in high beta versus low volatility ratio, as well as in biotech. We'll discuss those, but the other two, so 2 out of 4 in credit spreads and discretionary and staples, those look good. Those look very strong. We'll talk about 4 sectors that you guys want to watch. It's very hard to be bearish on the market, when these 4 sectors look strong, right? And a lot of these look very strong. Yes, they've had some pullbacks, but we're not seeing massive deterioration, and it doesn't appear like, all of these have completely rolled over. We'll also look at basically your average stock in the stock market. What's that doing? What's that look like? Well, you can measure that through the value line geometric index. This looks very clean and healthy. A nice consolidation flag here after a bullish uptrend. Oftentimes these lead to continuation patterns. So we'll see if this can continue to the upside. And sticking on the average stock theme, when you look at the equal weight NASDAQ, just bounced off of prior resistance, the prior highs. We literally just tapped that and bounced. That's exactly what the NASDAQ 100 did before it went on a tremendous rally. Same thing with the equal weight S&P 500. It had a nice consolidation continuation pattern above base breakout levels. We love that strong move there. And the S&P 500 had very similar look in the past. And when we look here, there's something pretty interesting, right? When you look at the ratio of the equal weight divided by the S&P 500 market cap weighted, it does look like it might, it's seen a nice double bottom bounce here, bouncing off a prior demand zone. We could see this continue to outperform, and we'll kind of discuss what that means for the market. But it's really interesting because that looks like it could head higher. But when you look at the ratio of the Mag 7 divided by the S&P 500, this is a very clean falling wedge. You could call this a bull flag, whatever you want. If this breaks out, that means the Magnificent Seven are going to start pumping and outperforming the stock market, and that could drive the market cap weighted index higher. Right. And when you take a look at the performance, year to date, the Mag 7 is up 2.36%. Meanwhile, the equal weight is up 3.04%. So the equal weight is actually outperforming the Magnificent Seven, which is really important for that whole theme of it's only 7 stocks, or the top 10 stocks in the market, or what's driving all of the gains. We're actually seeing a little bit of the opposite here with the equal weight outperforming the Magnificent Seven. And then we'll talk about the number of stocks making new lows, and why this list right here is the most important chart you want to pay attention to in terms of signs of a breakdown and the possibility of entering a bear market, and how you can use this chart to spot that. So it's going to be a really great video. Be sure to smash that like button, subscribe to the channel for more. All right. We got some more stuff here. This is a really, really cool custom script indicator that we've got here. Basically going over the economic cycles. We'll break it down further. Red is the main one that we're paying attention to. That's a contraction cycle in the economy. And as we can see, this started to roll over, which is what we wanted to see. And we wanted to see expansion break out. The last time we reviewed this, expansion was making new lows as contraction was making new highs. And that was something for us to monitor. Now, as always, the content provided on this channel is for informational and educational purposes only, is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through that disclaimer, okay? And we'll go ahead and talk about the newsletter real quick. All right, there's a completely free newsletter where I give out free, valuable finance and trading related content, and I also give out tons of free trade ideas in there. Use that link in the description to sign up for that. You can check out the website and read some of the previous articles, see if it's something that you guys are interested, and the link is in the description. Okay, now if you do want to join the investment intelligence private trading group, use that promo code Powell, and that will get you guys a very nice discount on your membership. And in there you get tons and tons of stuff. You get 20 plus swing trade ideas every week. You get custom scripts and indicators such as the ones that we're going to be reviewing in today's video, as well as exclusive chart layouts that we're going to be using in today's video, exclusive intel, and much, much more. So it's a really, really great community and in my opinion, value. Now let's go ahead and start. Okay, what was the signal that the bond market was telling us, right? Well, it was signaling that hey, we could see a pullback in the stock market. Okay, and it's just that simple. Now, what we're looking at on top is going to be the HYG. This is your high yield, and then we've got the S&P 500 on the bottom. Now, Wall Street tends to call this smart money, and they call this dumb money. Okay, and we had this period here where the S&P 500 was continuing to make new highs, while the HYG was making these lower highs right here. And so what people are going to tell you is that hey, the bond market is sending a signal here, right? You should see these moving kind of together. But we didn't get that. Oftentimes these divergences can end up leading to pullbacks in the market, right? We had one over here where, dumb money was just continuing to rally as smart money was really just going sideways, slightly making lower highs here. And then we saw a nice correction, and there's been multiple times where you can see these divergences. All right. Oftentimes you really have to let these things play out, and it's hard to predict exactly when they're going to cause a sell-off. But it's just something you can monitor as a signal and say, okay, hey, well, what are some of the risks right now in the market? This is one of them. What are some ways I can prepare and be, essentially be ready just in case we start to see a pullback, such as the one we've gotten recently. You can also use the high-low index. Okay, so this is the number of stocks making new highs versus lows. And this is a really good signal here as well. There's oftentimes when you see this going up and the stock market going down, that's a good buy signal. That's a bullish divergence in this case. And most recently, we had a bearish divergence, right? We were making lower highs on the high-low index as the S&P 500 was making higher highs. And if you think about it, right, the S&P 500 is 500 stocks, all right? If it's continuing to go higher, you should see more stocks making more highs than lows. But in this case, we're seeing that decline, the number of stocks versus lows decline. And that can be a sell signal, right? Now, it's not a bear market sell signal like, oh, hey, panic, sell everything, the S&P is about to drop 20%. But rather, hey, maybe things are getting a little bit frothy. This is a divergence signal here, and maybe, we can prepare ourselves for some type of a pullback and look to perhaps buy the dip and capitalize off of that opportunity. You can also use the McClellan's, right? There's the McClellan Summation Index, the McClellan Oscillator. Same thing, when you compare these things with the S&P 500, oftentimes you'll find divergences. We had a very large divergence here, negative divergence on both the Summation Index and the McClellan Oscillator. And you see we had that very sharp pullback afterwards. Most recently, we had a smaller divergence on the McClellan Summation Index, a negative divergence as the S&P was going higher. This was going lower. But currently what we've been developing, and we've seen a strong rally in the stock market over the past week or so, is, we were making new lows, but on the McClellan Oscillator, we're going up, right? We're making higher lows. So as the S&P is making lower lows here, the McClellan Oscillator is actually making higher lows. So that was a bullish divergence. That was one of the buy signals. Okay. And we're going to start getting into what are some of the different buy signals here very shortly in the video. Now, we've got the US stock market on the top, the US dollar here on the bottom. The black lines symbolize the normal relationship that they have, whereas the dollar is going up, you typically see the stock market pulling back. And as the stock market is going up, you typically see the dollar pulling back, right? So these have a negative relationship, right? An inverse relationship normally. So a divergence from that would basically mean that both of them are moving in the same direction. And, this isn't something that I just kind of discovered this, but whenever we do have these periods where the dollar and the stock market are going up at the same time, it tends to be about a 4 month period. Initially we had that 4 month period where both the stock market and the US dollar were going up, and that led us into the bear market in 2022. All right. But recently, in the past 2 years, we've also had 4 month divergences again from its normal relationship where both the dollar and the stock market are going up at the same time. And, initially we see the dollar peak and start to roll over, and we see the stock market pull back. But eventually, as the dollar continues its sell off, we actually see the stock market continue to rise there. So it goes through this weird period where they're both going up at the same time, and then they both start to go down at the same time. But as the dollar continues to go down, you'll see the stock market go back to its normal relationship where the stock market starts to go up. And sure enough, we had another 4 month divergence here. There were question marks here a couple months ago and question marks here of a rug pull. And look exactly like the drawings just lined up, very, very well here. And we did get a quote unquote rug pull, right? Especially from that FOMC meeting. The stock market was bright green on that day and then had one of a very, very strong close. It was a huge intraday swing right there. So, a lot of people took that as a rug pull. Treasury yields have been skyrocketing and continuing to send the market lower. And we're starting to see a little bit of rebound in the market. Now, credit spreads look good at the moment, okay? So there was a negative divergence signal here, a very, very small one. And again, oftentimes you can see these divergent periods here, but there was a very small one here, and we did get a little bit of a pullback. But if you take a look, credit spreads are making new highs. All right, and this is good. This is a bullish sign for the stock market. If this is rolling over, then there's concerns. All right, and you don't really want to see that. So whenever this is going up, whenever this line is going up, whenever you see credit spreads rising in this HYG IEI ratio, that's a good outlook for the economy and for the stock market. Now, when you take a look at the percentage of stocks above their 50 SMA, there's plenty of times where it gets into, let's just call it oversold territory, around 20% or lower. And we've marked these on the S&P 500, and you can see that we've gotten nice bounces, some of them short term and lead to a continued sell-off, and some of them longer term, right? This was a great long-term buy signal over here. This was a great long-term buy signal over here, here was a short-term signal where we got a nice bounce. And here, recently, again, we dropped well below that 20%, and we're seeing a bounce already. So we're going to let time will tell. Is really the only way to measure whether or not this was a good long-term buying opportunity or if it was just a good short-term buying opportunity. But again, that signal works really, really well. Now, another positive thing that we had about the market that I was monitoring throughout this continued sell-off, and another way to look at it is the market just went sideways, right? For about a 2-3 month period, essentially, we had a strong rally, we gave back those gains. So essentially the market went sideways. But what was happening underneath the hood? Was there any warning signs besides some of those divergences that we saw? And we didn't see any warning signs in the relationship of growth versus value, right? We've got Russell 2000 growth versus value at this time right here, where the market's going sideways and pulling back even. We're continuing to see higher lows and a strong uptrend remains. And we also see the same exact thing in the S&P 500 growth versus value measurements. So growth versus value is something that basically kind of demonstrates what type of environment the market is in. When growth versus value is going up, when this chart is going up on both of these, this means that growth stocks are outperforming value stocks. In bearish environments, you typically will see value stocks outperforming growth. So you'll see growth underperforming value. And take a look at what I mean by that, right? You see this sell-off right here. And what do we see in both of these charts? We see that this is going down. We see that this is going down. This means that growth is underperforming value. Growth is underperforming value. And the stock market is pulling back, right? So, when we see this, this looks good. We're saying, hey, we're still technically in a bullish environment, even though we're pulling back right here. Perhaps there's a buy the dip opportunity somewhere in the market that I can take a look at, or maybe I don't need to panic as much and try to short everything as much as I can because growth is still outperforming value underneath the hood, even though we're pulling back. Now we've got the nicely advanced decline line right here. And basically above 35,000, this looks good, right? This is in a strong uptrend. We had that bear market in 2022 where we pulled back and finally, October 2023, we come out, make new highs, and the market has been looking really, really well afterwards. So I'm not seeing anything screaming, panic sell or, that we're about to have a huge bear market as long as this line is above 35,000. Now, if it starts to break down, well, then we're going to be starting a new trend, right? And what do I mean by that? Well, the trend has just been nothing but higher lows, right? So lows, higher lows, higher lows, higher lows. Okay. But if we were to come in here and break below that level, we've got a low and now we're making lower lows. Okay. Then that's going to be a sign of deterioration in the market and definitely something that we want to continue to monitor, right? I mean, if you take a look through here, as soon as we, stopped putting in those higher lows and started putting in a low and a lower low, that was one of the first signs that, hey, we're entering a bearish market. We're seeing more stocks declining than advancing. And that was an early sign of the bear market that we had in 2022. Right. And we're just not there. We just don't have that right now. So, even if it breaks below 35,000, it's not the end of the world, but it is definitely something to monitor. We want to see this continue to make higher lows and not lower lows. So as long as it's doing that, we're in a bullish, healthy market environment. Now we're going to look at some intermarket relationships here. We've got Bitcoin futures breaking out. We've got the NASDAQ 100 breaking out, and we've got the S&P 500 on the verge of perhaps breaking out. These two are higher beta essentially meaning that they are more volatile to the upside and to the downside than the S&P 500. So they move quicker, essentially. And we're seeing Bitcoin, which is a higher beta than the NASDAQ, with a strong breakout here. We're seeing the NASDAQ, which is a higher beta than the S&P 500, breaking out here. It's very possible that two of these could be leading indicators and could be a potential sign that the S&P 500 is gearing up to break out in the short term. Now, when you look at the Dow theory, which is basically, if the economy is doing well and the, industrials and companies manufacturing all of these goods are doing well, then the companies transporting those goods should be doing well also, okay? Because those companies still have money to pay the transports, the transportation costs. They're not trying to cut costs. They may be paying for expedited service, et cetera, et cetera. You want to see transports doing well if industrials are doing well and the stock market is doing well. That's kind of just a quick summary of the Dow theory. And it's been lagging, right? We finally broke out and got new highs. That was a very, very good sign. And then it rolled over sharply, but look what we did. We bounced right off of our breakout levels here. So good sign in transports, right? Yes, we want to see this continue to go higher, but if you take a look, we are making a strong trend right now and continuing to put in higher lows. So even though we pulled back, we didn't completely roll over. We've got lows, we've got higher lows, and now we've got soft higher lows. As long as we can continue to hold those and rise on the transports, then we've got a healthy sign in terms of the Dow theory. Nothing to panic about there. When we take a look at some more intermarket relationships, we've got high beta versus low volatility. So as this goes up, this means that high beta stocks are outperforming low volatility stocks. This is an area where we want to see the market improve. Okay. You can use these as potential buy and sell signals as well whenever you see negative or positive divergences. For instance, at the bear market lows of October 2022, the S&P 500 is making lows and lower lows, but on the high beta to low volatility, we had a bullish divergence. We're making lows and higher lows. Discretionary versus staples was following this chart, but we had a bullish divergence on credit spreads, right? On the HYG IEI ratio chart. And then in biotech, we also had lows and higher lows. So 3 out of our 4 risk on versus risk off, offensive versus defensive, under the hood, measurements were telling us that, hey, even though the S&P 500 is going lower here, there's a lot of signals that underneath the hood, we're actually getting more offensive and we're actually getting more risk on. And that ended up being a signal that sparked, the bear market lows. Now, recently, we've had a negative divergence in the high beta versus low volatility. We've seen a little bit of a pullback. You could say that divergence has already played out. And biotech also, biotech, failing to break out and make new highs here, was forming a nice little base, but then it just completely rolled over. Now, some people may be wondering, why is biotech in this? And if you ask me, biotech is one of the most risk-on asset types or sectors of the market, rather. Because think about it, biotech companies are usually, profitless and just burning through tons and tons of money on R&D research, trying to develop some type of drug or product that will skyrocket the company into profitability once you get FDA clearance and approval and things hit the market, et cetera, et cetera. So until then, a lot of those companies are just raising money and spending all that money and not really getting any profits until they, finally come up with a drug or product. So to me, that's definitely a very risk on, risk off asset, sector of the market. If you see that rolling over, it's telling you, hey, people aren't necessarily as risk on. And when you see that breaking out, well, it's telling you that they're willing to, risk investing in these profitless companies. So that's why we have that in there. Okay. Now, this is a good chart right here. What we've got is going to be, just four sectors of the market that you really want to monitor. And you can look at this and get a brief glance of the market. These are very important to the economy and the stock market. We've got semiconductors. Obviously, we all know why those are so important. You could argue that those are basically the new transportations, the new transports. And why might you say that? Well, because what is the goods and services? What's the biggest product that the U.S. has to sell, to other businesses? And it's technology and it's data. What transports all that data? What makes that technology work? It's the chips, right? So in a way, semiconductors have become the new transports in the economy and the new digital age. Then we've got home builders. Okay, home builders very important to the economy. Okay, we want to see expansion in real estate. We want to see people building new homes. And we want to see the real estate market looking good. Even if in terms of like inventory and buying and selling properties that are already there, we want to see it's a good sign for the economy if home builders are going up. Okay, and home builders are continuing to improve their earnings. Once you start to see those roll over, that's not too good of a good sign. Then you've got broker dealers. Okay, think about how good or how important those are to the financial markets, right? And broker dealers look like they're breaking out to new highs here. Semiconductors look like they're trying to break out of a downtrend, a short-term downtrend. You've got home builders that had a little bit of a rollover here below that 107 level, but now we've quickly reclaimed it. So we'll see if this is a famous, plumber's pivot pattern where, the bulls or the bears are looking for a flush, essentially, right? So let's kind of discuss that real quick. So we've got a top here. Bears are getting over aggressive now on the break of this top neckline, looking for a flush to the downside. And the plumber's pivot essentially says that, oh, well, now they have to pivot and pick up the phone, call a plumber because they can't get the flush that they're looking for. And, what that means is that call is a margin call. Like, hey, you're getting margin called, you're getting stopped out of your short position. Is kind of where that comes from. And then you've got industrials looking good, slight pullback, bouncing off some prior, support over here, some prior resistance. So, it looks very healthy, right? Resistance, now support looks very, very healthy. So, when I look at these four, just to get a brief overview of the market, I say, hey, maybe I want to see a continued, improvement in home builders, but nothing about this is screaming bearish to me, right? And I'm not, looking at this saying, oh man, the market, it looks really bad. Same thing with the value line geometric index, okay, ticker value G. We had a very strong uptrend in here. We've been consolidating here above its breakout levels. We had a failed breakout here, failed breakout here. False moves tend to lead to fast moves, and you saw a sharp decline. But since then, we're really just, flagging and consolidating, forming a nice triangle pattern here. And we're going to see if this can break out towards the first quarter, second quarter of the year, and come up to some of our bullish price targets to the upside and create new highs in the value G, make some new 52-week highs. The equal weight looks really good, bounced off of prior resistance, right? Former all-time highs in terms of the equal weight NASDAQ, and we just bounced off of those former all-time highs. This looks very similar to what the NASDAQ 100 did just about a year ago, right? We had former all-time highs, resistance turn into new supply or turn into new demand and support, and we saw a continuation of a strong uptrend here. So equal weight looks good. Equal weight tech looks good. The equal weight S&P 500 looks good. Yes, we did roll over, okay, but we just went on a massive breakout, right? We had this triangle pattern here that looks very similar to what the value G did, where you had the uptrend and then a little bit of consolidation and a strong move to the upside. Now we're just absorbing and digesting some of that strong move, but we're still trading above, prior support. Continuing to make higher lows here in this process. So if this holds in as a new higher low, we're just doing nothing but continuing the uptrend, right? Now, here's where things get interesting. This, RSP divided by SPY, this is a ratio chart of the equal weight versus the market cap weighted S&P 500. So as this chart is going up, it means that the equal weight is outperforming the market cap weighted. Um, you know, for now, it's setting up a potential breakout, but we're not really there yet. Okay. We're kind of in the midpoint between support and that resistance trend line right now. So this could roll over, but it's definitely something worth monitoring, right? And if you start to see this continue to rise, remember that means that the equal weight is outperforming the market cap weighted, and it most likely means that some of those heavy weighted stocks are experiencing some pullbacks in the market. Now, when you look at the ratio chart of those heavy-weighted stocks, the Magnificent Seven, via this line chart right here, you guys can see a very, very clean setup. This one is much closer to its breakout trend line. So if this breaks out here, we could see stocks like Tesla continue to rally, start catching a bid. Nvidia, we saw that the SMH, the semiconductor ETF, looked like it was trying to break out. We have already seen that Bitcoin and the Nasdaq was breaking out. We're waiting on the S&P 500 to break out, but the equal weight has been outperforming the market cap weighted as of here recently, and so that's going to be a little bit of a headwind for that SPY, for that S&P 500 ETF. Because those heavy weighted stocks aren't really carrying their weight and pushing the market higher. If this breaks out, that could be a strong sign that we're going to get that S&P 500 breakout that we're looking for. Now remember, the Magnificent Seven has actually underperformed. Okay, when you take a look at the year-to-date performance, which we'll do real quick, I'll go ahead and show you guys. We've got year-to-date, the Mag 7 up 2.36%. Year-to-date, we've got the RSP up 3%. So, the equal weight almost outperforming by a full, percentage point at this moment. And from a technical standpoint, things look good, right? The equal weight bouncing off prior resistance, right? We've got support here. That was prior resistance. Same thing with the Magnificent Seven, right? We've got prior resistance coming down to support and bouncing off of there. So even though we have experienced a pullback in the market, the purpose of this video is that, hey, there were some, signals that you guys can look at and monitor yourselves to see when there could potentially be pullbacks in the market. And in many different places in the market, we're seeing bounces off of support. We're seeing old resistance turn to new demand, into new support, which is very healthy and a good sign for the market. The big thing you want to monitor in terms of, market deterioration and whether or not we're heading into a bear market is going to be the number of stocks making new lows. Okay. And you're going to see it develop on the 1 month lows first, then the 6 month lows, and then 52-week lows. All right. You're going to start to see the progress change in those. And look what happened. Those are rolling over. Those are making lower highs. Those are back in a downtrend, right? We did have that really big spike around, the December FOMC and Jerome Powell. But since then, we've seen those roll over, and those are all back now in downtrends. And we're making some pretty low lows here in the number of stocks making new lows on a 1 month, 6 month, and 52-week, perspective here. So that looks good for the market at the moment. If this starts to break out and starts to make some new highs, that's definitely going to be a warning sign for the market and a big sign of deterioration. You've got to have more stocks going lower for the S&P 500 to go into a bear market. And what this chart is showing you is that we did have some stocks go lower at one point about a month ago, but since then, we're seeing less and less stocks making new lows. If you're not making new lows, then you're not in a downtrend, and it's just that simple. Now, this is a really amazing chart right here. I like this one a lot. What we're looking at are different economic cycles, okay? So essentially, what we've got here And we've got the titles of them, but it's a little bit hard to see. I know that, so I'll explain it to you guys. So green is expansion, okay? Blue is peak, red is contraction, and then yellow is recovery. So these are different, economic cycles, right? You've got a contraction cycle, you've got a recovery cycle, you've got a peak, you've got expansion. And, for right now, we still look like we are in expansion. Okay. If you take a look here, we had this period here heading into 2022 where, expansion was making lower highs and contraction was continuing to make higher highs. So, we're seeing expansion this cycle deteriorate as we're seeing contraction improve. And that was, a little bit of a warning sign for the market. And if you take a look at what we have right now, I pointed out, prior, we had this period where expansion was going down as contraction was going up, something, to be a little bit worried about and to continue to monitor. But since then, we've seen the contraction phase roll over here, and we've seen, expansion continue its really strong uptrend. So that was a really good development. I'll be continuing to monitor this just to see, how things go. If contraction really starts to break out and ramp up here and this starts to roll over, that's definitely going to be, a signal and another warning sign for the market for us to continue to monitor. Now, don't forget to sign up for that newsletter. Okay. I debuted the very first zone finder trade idea in the newsletter completely for free. The zone finder is something that charts supply and demand zones for you guys automatically, so you guys don't have to do it. I know a lot of people struggle with trying to draw supply and demand. And then you can run the scan to find stocks that are trading in demand currently. And the very first one we had was BMY, Bristol Myers. Had a very nice setup here with the falling wedge as well as being in demand. And you can see those call options went really well. So if you guys want to join the Investment Intelligence Private Trading Group and get access to the Zone Finder custom script and scan, as well as the other custom scripts and many other things, use that link in the description. Promo code Powell will get you a nice little discount on the Discord access to the private trading group. Inside of there, you get 20 plus swing trade ideas every week. You get those custom scripts and indicators, exclusive intel, exclusive chart layouts, and much, much more. And for completely free, you guys can just sign up for the newsletter. Okay. In there, I'm giving out free, valuable finance and trading related content. You can go back, check out the website, review some of the stuff that I've published, that I've posted. We had an article in the beginning of the year about natural gas, how natural gas was breaking out, how you could potentially capitalize off of that through a couple different stocks. And some of those plays have been working out really well, specifically EQT, right? So go ahead and check out that newsletter, look at the setups that we're identifying, and then look at the charts today and how they're trading. And you guys will get a good sense of what type of content I'm trying to deliver to you guys. So thanks again for watching. Smash that like button, subscribe to the channel. If you want a coaching session or you want to reach out and feel like you need that one-on-one touch, go to my Ko-Fi page. There's a link in the description there. You click on the commissions tab and you can book a 30-minute or you can book like a 1 hour session, whatever you guys want. They also have this cool little buy a coffee button, basically a way to leave like a tip or donation for all the free valuable content I put out, such as the newsletter and such as these free YouTube videos.